The venture capital asset class, the engine behind everything from your search engine to your next-generation vaccine, operates on a statistical reality that is anathema to every other form of finance. Over 75% of its investments will fail to return the capital invested. A full third will go to absolute zero. And yet, the top decile of VC funds have historically outperformed every other asset class on the planet, often delivering net internal rates of return exceeding 30% annualized over a decade. This isn't just a paradox. It's a declaration of war on conventional financial logic. The entire system is engineered to lose money constantly, systematically, and spectacularly, because it understands a fundamental truth about innovation that the rest of the market refuses to see. The question isn't how it survives this failure rate. The question is how this failure rate is the very mechanism of its astronomical success. To understand this, you have to dismantle the core assumption of traditional investing, the bell curve. Modern portfolio theory, the gospel of Wall Street, is built on the Gaussian distribution. You buy a basket of assets, say 20 different stocks. Some will go up, some will go down. Your goal is to diversify, to mitigate risk, to shave off the tails of the distribution curve, to land somewhere in the fat middle of predictable, manageable returns. A catastrophic loss in one stock, a minus 50% drop, is a disaster to be hedged against. A huge gain, a plus 100% pop, is a welcome anomaly. The entire strategy is about averaging out to a positive number. This model is fundamentally allergic to a 75% failure rate. It would implode. An atomic example. You give two classic portfolio managers $100 each. They each invest in 10 companies. Manager A's portfolio has 9 companies that return 2x and 1 that goes to 0. His total return is $180, an 80% profit. Solid. Manager B's portfolio has 9 companies that go to 0 and 1 that returns 20x. His total return is $200, a 100% profit. Manager B, the one who experienced a 90% catastrophic failure rate, is the superior performer. The traditional system is optimized for Manager A's world. It seeks to find many small probable wins. It cannot comprehend, let alone build a strategy around, Manager B's world, which is governed by a completely different physical law. The conceptual leap, the animating principle, doesn't come from economics. It comes from evolutionary biology. Nature does not operate on a bell curve. Evolution is not a process of incremental, steady improvement across an entire population. It is a system of radical, high-variance experimentation followed by ruthless environmental selection. For every successful mutation that leads to a dominant new trait, there are millions of neutral or fatal mutations that lead nowhere. Evolution doesn't try to make every organism a little bit better. It generates a Cambrian explosion of diversity and lets the environment select for the single outlier that is so perfectly adapted, so overwhelmingly superior that its success renders all other variations irrelevant. Venture capital is not portfolio management. It is financially accelerated directed evolution. The goal is not to mitigate risk by finding the average. The goal is to maximize exposure to outlier events by funding the mutations. It is a search for the positive black swan, the 10,000x return that pays for every single failure in the fund and the next fund after it. The entire architecture is built to hunt this single creature. Let's pull the chassis apart. The foundational structure is the power law distribution, not the bell curve. In a power law system, a single event can account for more impact than all other events combined. Think of earthquake magnitudes or city populations. There is one Tokyo, and then there are thousands of smaller cities. In venture, one Google in a portfolio is worth more than 100 moderate successes. The entire fund is constructed not to generate a good average, but to find one power law outcome. This is executed through a 10-year closed-end fund structure. Limited partners, LPs, like pension funds and endowments, commit capital. General partners, GPs, the venture capitalists, deploy it. This decade-long horizon is critical. It's a strategic patience that allows for the long, messy, often failing trajectory of a startup. The GPs are compensated with a 2 and 20 model, a 2% annual management fee on committed capital to keep the lights on, and a 20% carried interest or carry on the profits. That carry is the kill switch. The GPs only make life-changing money if they return the entire fund multiple times over, a feat only possible by hitting one of those evolutionary jackpots. Their incentives are not aligned with safe, modest returns. They are existentially aligned with the outlier. The portfolio construction reflects this. A VC fund doesn't diversify. It anti-diversifies. It assembles a portfolio of 20 to 30 companies, each of which is a statistically improbable bet on a world-changing outcome. They are not looking for correlated assets. They are looking for a collection of orthogonal moonshots. They screen thousands of companies to find the ones with the steepest power law potential, massive addressable markets, network effects, proprietary technology. The key isn't just picking. It's what happens after. The initial check is just the entry ticket. The real mechanism is the follow-on investment. The fund reserves a significant portion of its capital to double, triple, or quadruple down on its winners as they emerge from the primordial soup of the portfolio. This is the selection pressure. They starve the failures, letting them die is a core competency, and they funnel all available resources to the breakout successes. They are not watering the whole garden. They are identifying the single redwood seedling and diverting the entire river to it. This process is brutal, inefficient by traditional metrics, and produces an ocean of dead startups. But it is the only known economic engine capable of consistently capitalizing the frontier. This is not about funding another social media app. This is the model that funds synthetic biology, quantum computing, and commercial fusion energy. These are ventures with immense technical risk and a near-certain probability of failure. Traditional capital markets, with their quarterly earnings reports and obsession with predictable cash flows, cannot and will not underwrite this kind of radical uncertainty. The system built on embracing failure is the only one that can afford to take a credible shot at solving humanity's hardest problems. We're not just looking at an investment strategy. We are looking at a machine for converting catastrophic failure into paradigm-shifting progress. This engine doesn't just tolerate a world governed by power laws. It has become the dominant predator within it. The future will not be built by cautious diversification and the search for the mean. It will be forged by a system that understands the profound evolutionary truth that the only way to guarantee a truly monumental victory is to be willing to underwrite 1,000 noble defeats. This isn't finance. It's a high-stakes protocol for manufacturing serendipity, using the compost of failed ideas as the fertile ground for the one that changes everything.